Okay, now it's time to take a look at our findings. We've been asked a couple of questions here for this problem. First of all, to which one would you, as a credit manager for a supplier, approve the extension of short-term trade credit and why? First of all, as a supplier or a short-term lender, you're probably going to be most concerned with liquidity ratios, the current and the quick ratio. And if you take a look just at those, Smith Corporation would probably be the one you'd choose as having the best ratios in that category. You can see our current ratio for Smith, 2.5, is substantially higher than Jones at 1.5. And the quick ratio, even once you take out inventory, is 1.5 with Smith versus Jones at 1. You could argue that Smith had benefited from having its debt primarily long-term rather than short-term, and you can see that in the debt to total assets at times interest earned and fixed charge coverage ratios. But it does appear to have better liquidity ratios. Smith has better liquidity ratios. Therefore, as a credit manager, you might choose Smith over Jones and give Smith better credit extension, credit terms than you would Jones. And then to which one would you buy stock and why? Well, investors are most concerned with profitability, and in that category Jones has much better ratios than Smith. If you take a look at profit margin, Jones is substantially higher than Smith. Return on assets, they're stronger. Smith does have a higher return on equity than Jones, but this is due to its much larger use of debt. It's much more highly leveraged, therefore it does have a little bit better return on equity, but that's also more risky. And investors take that into consideration, especially at the level of debt to total assets that Smith has compared with Jones. It's just simply taken more financial risk. Jones has its interest and fixed charges well covered, and in general, its long-term ratios and outlook are far better than Smith's. Jones has asset utilization ratios that are equal to or better than Smith, and its lower liquidity ratios could reflect better short-term asset management on Smith's side, but the bottom line on Jones' side, but the bottom line is that Jones is a more solid investment, it appears, than Smith in this case. So most investors would choose Jones over Smith and pay more from a share standpoint. If there were the same number of shares outstanding for each company, Jones would sell at probably a higher value than Smith. However, you always have to make sure you take a look at more than 1 year's comparative data, and we're just looking at one. So keep that in mind when you're analyzing companies and determining investment decisions.